Hey guys, welcome back to the channel. My name's Max Convexity. It's a big day here at the channel today as I have Will from Granite Shares, and he's going to tell us a little bit about himself right now. So Will, please tell us about yourself.
Thank you very much. And first of all, thank you very much for having me. Absolute pleasure. So as you rightly pointed out, I'm from Granite Shares. I'm the founder and CEO. We are an ETF company, which means that we're an asset manager that specializes in the creation, the listing, the management of ETFs or exchange traded funds. We're headquartered in New York City. Company's been going for 7 years. We managed over $8 billion and all sorts of different strategies, ranging from things like physical gold to subject of probably a lot of conversations this week, but 2 times leverage NVIDIA and sort of everything in between.
Well, so would you guys be considered a white label provider, ETF provider? Could I have an ETF idea and bring it to you and you guys would sponsor it, or are you guys all in-house with your own stuff?
We're all in-house, so we don't do white label ourselves. Typically, we are the intellectual property, if you want to look at it like that, whereby we come up with the ideas, we design the ETFs, and then we launch them. That's not to say that we couldn't do that. It's just not a sort of a business line that we've sort of chosen to focus on.
I was just curious. We deal with Tidal a lot because they're the sponsors for Yield Max. So I didn't know if this was a similar business model or not. And I understand. So you guys do your own sub-advising also, or do you contract that out as well?
No, we do everything ourselves.
Okay.
So we have our own portfolio management, our own trading, our own advisor. So everything is kind of vertically integrated, if you want to look at it like that. We only really get IP from index providers if we are using an index, for example.
Perfect. So, and this is your company. You're the founder. Where did you work before? What's your background, if you don't mind me asking?
So, no, not at all. My background is really in ETFs. So with the exception of a very sort of brief stint, 1.5 years or so working at an investment bank, first job out of college, back 25 years ago, I really spent all my life in the ETF world. So I moved from investment banking into Barclays Global Investors, or BGI as it was known then. The company started the first ETFs. We're working on the first ETFs in Europe under the iShares brand. And then most people will know that that company was acquired by BlackRock in the financial crisis. And now, it's just known as BlackRock with the iShares business. So I started there. Stayed with ETF, did a startup afterwards called ETF Securities. That firm was focused on commodity-based ETFs and became pretty successful, was ultimately sold to Wisdom Tree and a couple of other sort of parts. And then I was the CEO of the World Gold Council, some joint venture with State Street of the GLD ETF. I was CEO there for 2.5 years, and then left that and started Granite Shares.
Okay, yeah, that's interesting. Okay, yes, you do have a background. I looked on the internet real quick, and all I saw was the 2 years in private banking or whatever. So that was that's kind of what I thought about you. But yeah, I didn't research enough. Well, let's talk about ETFs then. So at my channel, we really like ETFs, but we really like ETFs that sell premium. We're into the covered call and those types of ETFs. Now, I understand you guys do right now have a high yield. We also like any kind of yielding ETF. I understand you guys have something called HIPS, HIPS. Do you want to tell us a little bit about that?
Yeah, so that's at the moment, our high income offering. So HIPS stands for high income pass-through securities. That's an ETF which focuses on, as the acronym might suggest, a particularly kind of interesting part of the market, in our opinion, called pass-through securities. And pass-through securities are things like MLPs, or master limited partnerships, which own energy infrastructure, typically oil and gas pipelines, business development companies, or BDCs, which are almost like private equity funds for small and middle sized businesses. Then you have closed-end funds, which can be all sorts of different strategies, and then REITs, of course, real estate investment trusts, which can cover physical property, they can cover mortgages. But the point is, all of those together, they don't pay corporation tax. They're not corporations, they're pass-through vehicles. So automatically you kind of start with a higher level of income, which is interesting. And HIPS, the kind of the unique thing that we like to talk about is it pays a fixed cash distribution. So it pays 10.75 cents per share per month, or $1.29 of income per annum, and has done that now for about 6 years. So through rain or shine, it's paid that fixed distribution. And what that means is that if you buy today, or if you buy in 6 months' time or a year's time, you're locking in that yield at the time you buy because of the fixed cash distribution. So right now, that's a little over 10% per annum.
Okay, so then your only risk in the deal is that the principal can go down, and I guess that's like
right.
in any income investment. Okay, well, no, that sounds awesome. That sounds awesome. Now, let me ask you. So, Yield Boost is a product of yours that's not out yet, or a sub. Tell me about that, or to the extent you can.
Yeah, so I can't say too much about it because we are in a quiet period, a regulatory quiet period. But as you rightly pointed out, and given your channel and the stuff you love, this is going to be very relevant for you and your audience. And we have a filing in under the sub-brand Yield Boost. And Yield Boost is going to be a series of income-producing ETFs that all use options. And the idea being that, similar to what you've seen from other providers in the market, this time it's unique, blending two sort of unique attributes to create what we think is going to be a very exciting range for people that are looking for that kind of payoff.
And the attributes would be, without talking about too much, would just be leverage and, I guess, leverage and yield, right? So okay.
That's it. Yeah. Yeah.
Well, when you guys scheduled this interview, I was thinking maybe it was because it was my channel. I was hoping that maybe the announcement was even going to be this week or going to be pretty soon. But anyway, we'll keep looking for that. And I would love to have you back on because I'm going to have a million specific questions on option type questions on those funds. But that's fine. I have plenty of other questions too. So I was also very interested, even though my fund concentrates on options and everything. I realize growth investing is what pays the bills. I'm a growth investor at heart. The only reason I like options for income is because I've had enough growth, and I'm looking for a little diversity and a little income now. Well, anyway, I was really interested in your fund. That's the Disruptive Technology Fund. Would you care to tell us about that one? That one's really fascinating to me. What's the symbol? DRUP?
Yep, DRUP or DRUP, and that is exactly what you've just described. So very much, although growth is not an actual factor that we use, it's definitely very much orientated in that space. So trying to really map disruption or high innovation and use that in a disciplined way to create a fund that scores companies or evaluates companies on 6 fundamental criteria or factors. And then that creates a score on which we take the top 50, and that's from the large cap universe. So you end up with what we think is the top 50 disruptive names in the market, and that's that measure, if you will, is scored by NASDAQ. So it's a NASDAQ index and research benchmark.
So I'm interested in how that happens. It's based on your research and your factors, or it came out of your brain. But now it's a NASDAQ index. They license the index, or how does that work?
Yeah, so just to be clear, it was a kind of collaboration with both of them, but ultimately that is a NASDAQ index, which means that the bulk of the research that was done in that particular domain came from NASDAQ. So we certainly had input into it, but I wouldn't claim by any means that this was our IP just with a NASDAQ name on it. This is firmly a NASDAQ researched index. I think it's very interesting.
I got you. So I get you. Okay. So is there any other funds that are also using this index that you know of? I mean, I guess.
No, it's unique to us. Yeah, it's unique to us. So typically that's a thing that we like to do. We like to do funds that are unique. Now, that's not always possible, and especially we can't control what competitors do. So if competitors copy one of our funds in the market, then by definition, you have something that's less unique than it was. But we try and focus on things that are unique. And one of the ways we can do that is we try and control, if it's an index, for example, the index IP, so that we are the only people that license that and therefore have that strategy. And that's the same with something like HIPS.
Okay. Well, yeah, that's no, that's a good point. I hadn't thought about that. Do you guys have any funds right now that are based on any other indexes that I might have heard of?
We have, for example, the COMB or COMB, as we like to call it. That's our broad diversified commodity benchmark. So think of that index is the Bloomberg Commodity Index, and that's almost like if you're not familiar with the commodity world, that's like the S&P 500 of the commodity world. So very, very well known, probably the most famous index in the commodity world. And like the S&P 500, albeit we don't have 500 commodities in the index with 23, it's the 23 most traded economically significant commodities in the world. And it's got a little bit of diversification in terms of sector limits. So you can't have one sector that's more than a third of the index. So it stops, for example, energy, being a vast overweight in the index or underrepresentation from certain parts of the industry. And that's just a nice way to diversify, for those that are looking for a 5% allocation to commodities, a 10% allocation to commodities, but fundamentally have no sort of, no idea whether oil is going to outperform corn or whether nickel is going to outperform zinc. And so it's really just that, set and forget type investment. So we have that's on the Bloomberg index. And then these ones don't have indexes per se, but we have physical gold, physical platinum, which is just literally bars of gold sitting in a vault, or in the case of platinum, plate and ingot sitting in a vault.
Now that's awesome. So the physical gold is really awesome. So there's because most funds right now use probably futures contracts, right? But then that has its own problems. Maybe you can tell us about why your way's better.
Yeah, so there's, two basic ways to get exposure to gold. There's either physical, which is owning the actual physical. And as we all know, gold is tangible. So that means that, we can go and we can buy it, we can feel it, touch it, hold it, store it. And then there's synthetically, and synthetically means that it's, you own a contract or a promise, but it's virtual, it's not physical gold. So in BAR, which is our flagship gold ETF, BAR, that's literally 400 ounce bars for the most part, LBMA or London Bullion Market Association good delivery gold. Those are what the official spot price for gold is measured off of. So typically when you look at a major website and see the price of gold, that's not actually the spot price, that's the futures price. It's the 1 month future for gold. Now they are quite close, obviously, but it's not actually the spot price, and the spot price is derived from these 400 ounce bars that sit in these vaults and are held by instruments such as BAR. So another sort of great lesson, with ETF 101, which is always, understand what you own and make sure that it's not, a ETF that's backed by paper gold or by virtual gold, which
unless that's what you want to own.
Real. Exactly.
Yeah. Unless that's what you're looking for. Now, I just made a video about an hour ago that's called Know What You Own. But yes, that's great advice. But speaking of that, you're a great source for ETF information. Here's something that I don't fully understand, and it's ETF specific that I think you could probably explain to us. Let's talk creation units. Let's talk, okay, on this, let's talk this BAR. So let's say I'm a family office and I'm managing 100 million or I'm managing $1 billion, and I want to give you guys 100 million. What do? You know that the ticket's coming in for, you have 100 million purchase coming in. How does the creation unit happen? Do you have a broker give you the physical gold and you give them the money? How does that work? Is it an in-kind transaction or not?
I'm glad we're specifically talking about this fund we're talking about, because I think this really helps to explain this process when you're talking again about something tangible as opposed to something intangible.
Yes.
And the way that BAR works is it's in kind only. So that means that we as a fund cannot take cash. We cannot take derivatives. It has to be gold. So gold in and gold out. And the way that gets facilitated is that market makers, ETF market makers, deal with, it could be the custodian themselves, which is a bullion bank. Or typically it's with any of the bullion banks that is able to buy and sell physical gold. And so for that 100 million, what they're going to have to do is go and facilitate a purchase of $100 million worth of physical gold, and then deliver that into the trust's account at the custodian. So they're delivering physical gold into the fund, and then
Directly.
in return, we're issuing the shares that match that 100 million worth of physical gold. So,
that's right.
yes.
You guys issue the shares, and then they get to sell the shares in the open market to recoup their money. Is that right?
Exactly. And then the reverse is also true. So if they want to redeem or sell, then ultimately that means that gold shares have to be canceled. The gold has to be released from the fund, and then they use the gold, liquidate that in the market, raise the proceeds in US dollars, and then pay back the investor that way.
So in that last example, you would issue the market maker, the authorized participant shares from Granite Shares, and they would give them to me or my family office. We would hold the shares. I'd give them the 100 million. Oh yeah. So that's, but the gold, you guys would just always in kind with gold, physical gold.
So we don't actually give them shares. We give them the gold. So the gold leaves, and then we cancel the corresponding shares that back that gold. And then the market maker sells the gold and then gives the cash to the client.
In the reverse transaction. Okay.
Yes,
Perfect.
reverse,
Perfect. No, that's really interesting. Yes, I've heard when I was doing my research on you that you're really into commodities, and I watched some other interviews with you, but I think that's such a key in financial planning, as I'm sure you know, inflation's the biggest problem. So what a lot of financial planners do, as I'm sure you also know, is make an allocation to commodities, but also what planners do is they make an allocation to maybe a fund that maybe uses a trend following commodities system and tries to even boost the exposure to commodities a little bit more by using trends. Do you have any ETFs that do any of that?
We do not. And again, I don't have a sort of strong view as to whether it's a good thing or a bad thing. We have the types of ETFs that we have, which are kind of fairly straightforward from a asset allocation perspective, either physical gold, which does exactly what it says on the tin, or platinum, or the commodity index itself. I know there are active versions, which is what you're sort of alluding to, which is there are all sorts of different strategies that you can use in the commodity world, just like in the equity world or the fixed income world. We don't have any of those in our stable. Again, nothing philosophically against those. It's just the way that we've sort of built out the business is the active sort of side of our business, or the much more racy side of the business, has been all about the levered single stock side.
Well, let's let you talk about that some. I'm not that much into leverage. I think it's, but anyway, I need to keep an open mind. I understand that NVDL is the #1 ETF in the world.
Yep.
Holy cow! How much do you guys manage on that one?
That's depending on the day, around 6 billion. Yeah. So it's gone to be one of the most successful ETFs in the world. And like I said, that's the largest leverage single stock ETF in the world. So it provides 2x leverage on Nvidia, which funnily enough, as we're talking obviously today, we have Nvidia's earnings on Wednesday, which is going to be the Super Bowl of the earnings season, the Q2 earnings season at least. So we've got that to look forward to this week. But as you know, people are really went crazy for Nvidia stock, and 2x that has provided investors with a huge amount of interest and a huge amount of return.
So how do you guys do that? Is that with the swap, or how do you guys make a 2x daily return? How does that happen?
Yeah, that's right. So the leverage is obtained in the form of derivative contracts called swaps. Those that we obtain from investment banks typically, but let's call them large broker dealers who have the balance sheet and the sort of trading technology to provide that sort of exposure. And they're effectively providing you the margin, the financing for leverage trades on single stocks. And our goal, if it's Nvidia, for example, and NVDL, it's to replicate 2x the daily return in the underlying stock. So if the underlying stock's up 5%, then NVDL is trying to emulate a 10% return for that day. And in order to do that, we obtain that leverage from these major investment banks or broker dealers.
So now, what's the downside? Isn't the downside have something to do with doesn't the magnification can cause erosion over a longer period than a day? Can cause asset price erosion? Is that right?
There's kind of two different things. So first of all, the risk is the classic risk and reward trade-off, that your risk is clearly much higher than if you are not using leverage, because it's 2 times levered. So that means that, like I said, if NVIDIA goes up by 5% in a day, NVDL got by 10%. But the reverse is also true. So if NVIDIA was to drop by 5% in a day, then NVDL would drop by 10%. So that's your classic sort of risk return paradigm, whereby, yes, the more risk you take, the more potential for return you have if it goes in your favor, but also the more potential for losses you have if it goes against you. Now, what you're kind of alluding to is that the way that these funds work is that they are path dependent, not linear sources of return. And the way that the path dependency is designed is that we're trying to keep it constant, the amount of leverage constant, which means that every day, regardless of when you buy or when you sell, it's 2 times leveraged. And we can only really do that by rebalancing the portfolio at the end of each day. And so while it may sound sort of obvious, that what the effect is of doing that is you start to compound returns. And when you start to compound the returns, the path can deviate from the underlying linear stock return, depending on what the market's doing. So a very overly simplistic example would be that these products really like trending markets. So if the underlying stock, like say NVIDIA, goes up 10 days in a row straight, then NVDL will most likely outperform the 2x linear return of that stock over 10 days.
Sure.
And the reason for that is because you're compounding those profits, the reinvesting those at the end of the day, and you're setting the 2 times leverage on top of that. Now, the converse is true. If it goes down by 10% over 10 consecutive days, then you will almost certainly underperform because, again, of that compounding effect. The bit I think you're talking about is kind of the math around, if the market drops by 50%, you have to recover 100% to break even, not 50. So it's a little bit like that. And if you have a choppy market where we go up, we go down, we go up, we go down, typically it means that if we go up by 1% and then we go down, you almost have to go up double to recover that break-even level. And if you consistently do that, that causes NAV erosion. But that's just the simple math around it. And I think a lot of people sometimes, maybe intuitively, I'm not sure, but find that difficult to understand the concept of a market drops by 50%. It doesn't recover by 50%. You're not break even. It has to recover by 100. So it's that thinking that sometimes I think causes a bit of confusion.
So the way I think about those, when I think of leverage funds, my first introduction to it was UVXY. That's one that I like to trade all the time, but it has some of these same problems. Now, were you at the company that had UVXY? Was that right? Or
not me, no. When we started Granite Shares, this is kind of an interesting story. So when we started Granite Shares, we weren't allowed to do leveraged ETFs.
Okay.
And that was because only 2 companies in the US had approval from the SEC to do that. And that was ProShares and Direction. So that's why they've been able to build these large businesses around leveraged products, because nobody else was allowed to do it. Now, the rules changed a few years ago, and that allowed companies like Granite Shares into the market for the first time. And that's why you've seen all this innovation. You've seen the invention of leveraged single stocks. You've seen huge amounts of innovation in this space. And that's all because of the change in rules or change in regulations. So yes, we were not doing that 7 years ago when we started the company, but now we can, and so can other people as well.
Well, that's awesome. What I was trying to get at is I'm hoping your new product line does some type of yield fund on UVXY, but I know you can't talk about it, so I'm not even asking you about that, but that's where I was going with that.
Yeah.
But let's talk about some stuff I can talk to you about. What about your opinion on NVIDIA earnings? You have a pretty good, are you one of these guys who believes in a random walk, or do you believe in trends and trading and stuff? Do you have an opinion on NVIDIA earnings is what I'm trying to ask.
Well, I do. So again, I think this one is not a secret in the sense that, I think that they will beat earnings, on Wednesday. And what's interesting is the reason, because that's not because I have a crystal ball at all. What's interesting about this is that the breadcrumbs, so to speak, in many ways have already been laid down by the other massive tech companies who are also their biggest client. So Microsoft is the biggest client of NVIDIA. They've reported an increase in CapEx, for 2025, alongside the already, gigantic CapEx spend for this year. And a lot of that is being spent on NVIDIA hardware for these hyperscaling data centers and cloud businesses. So we've already seen in these results, that Microsoft posted, that Google posted, Palantir posted, etc. Everybody's talking about not just CapEx remaining at an elevated level, but actually increasing next year. So I think that really that sort of almost tells you that the cat's out of the bag in terms of the earnings for NVIDIA. And really, in my mind, what people are looking for is not so much whether they beat or not. I think it's already there. It's more the guidance forward in terms of delivery of the new Blackwell chips, which was supposed to start delivering sometime in the back half of this year, which, there has been a manufacturing delay in those. We'll see, what the update is on that and whether that's going to impact in any way. And then I think more to the future, potentially with a potential change of administration. It's about the Chinese policy and whether any kind of export, restrictions might affect the company's ability to do business with China. But really that's sort of more future demand trends as opposed to, how the company's doing now, which is clearly very well.
Sure. And I'm guessing that traders might try to get in front of who they think is going to win the election, because one party might be worse or better on tariffs, depending on your point of view, but kind of like what you just said. I guess that speaks to.
We've already seen that, of course, with the Trump trade, and then, the sort of so-called, bounce or swinging back towards, Kamala Harris after, she sort of came out. So, I think it'll go back and forward a little bit as long as the poll numbers are indicating one way or another. But as we know, it's gonna come down to the wire, and it's probably going to be pretty tight.
So do you think, or I think I heard you say on another YouTube channel that these are make or break for the market for the end of the year? So maybe, is that kind of what you said, or did I paraphrase you right?
I think what I said was that NVIDIA is the most important earnings for the market, certainly of this Q2 season. So typically it's not, it's the last sort of major tech company to report. Everybody else has reported. So I think the question was more sort of in the background of Jerome Powell and, what was the most important thing for markets, and was it Jerome Powell sort of effectively announcing to the market that the first rate cut was coming in September. And I think my answer to that question was I actually think that NVIDIA earnings are more important than the Jerome Powell 25 basis point cut to interest rates that is most likely going to happen at the September meeting. So that was sort of the context behind that. But yes, I still think that NVIDIA earnings really is the most important thing for markets at the moment, because it's really the big catalyst that's driving the rest of the market up, particularly the tech stocks.
I totally agree with you, and yes, that's exactly what you said. I was hoping you would kind of repeat that on my show, because I agree. I think that's great knowledge. Well, Will, I really appreciate you being here today. It's been great talking to you. I wish you could talk about yield boost, but I understand that you can't. You have any final remarks, or is there anything we didn't talk? Do you have a fund that I didn't mention that you need to tell me about? Or, I mean,
No, I mean, everyone can check us out on graniteshares.com and look at what we've got, the different funds that we have to offer. But obviously, I'd love to come back to you and talk to you about Yield Boost as soon as I can. So watch this space on that.
Absolutely. I'm signed up for the email alerts at the website. As soon as they announce, I'm going to probably email you and try to set up a further interview.
Amazing. Look forward to it.
Well, hey, Will, thank you so much. It's been great getting to know you. And I'm going to say bye to the live stream now, but you have a great day.
You too. Great to talk to you. Been a pleasure.
Thank you, Will.